Ah, the stock market. Hi, my name is Jennifer, or just Jenny or Jen. A thrilling roller coaster of ups and downs, isn't it? For some, volatility is a source of anxiety. But for savvy investors, it presents an opportunity to profit from the market's swings using strategies like the short put Condor. This strategy, while a bit complex, can be quite intriguing, especially in volatile markets. So, what exactly is a short put Condor? Imagine a bird with its wings spread wide, gracefully gliding on air currents. That's the image this strategy evokes, with its multiple wings representing different options contracts. In essence, it involves selling one put option and buying another put option at a lower strike price, while simultaneously selling another put option and buying one more at an even lower strike price. All options have the same expiration date, forming a condor-like spread on the options chain. The beauty of the short put Condor lies in its potential to generate profit from a range-bound market. If the underlying asset's price remains within a specific range until the options expire, the investor keeps the premium collected from selling the options. This makes it particularly appealing during periods of high volatility, where predicting the market's direction can feel like reading tea leaves. However, like any good investment strategy, the short put Condor isn't without its risks. Understanding the intricacies of options, implied volatility, and the potential for losses is crucial before attempting this strategy. It's not for the faint of heart, but for those willing to learn, it can be a valuable tool in navigating the turbulent skies of the stock market. One of the most attractive features of the short put Condor is its defined risk profile. Unlike some other option strategies where potential losses can be unlimited, the short put Condor neatly caps both potential profits and losses. Think of it as a safety net for your investment, providing peace of mind in the often unpredictable world of finance. But how is this limited risk achieved? The answer lies in the very structure of the strategy. Remember those 4 options contracts we talked about? They act as boundaries, creating a box within which the strategy operates. The maximum profit is achieved if the underlying asset's price remains above the highest strike price at expiration. In this scenario, all options expire worthless, and the investor pockets the net premium received when the trade was initiated. Conversely, the maximum loss is limited to the difference between the strike prices of the sold put options minus the net credit received. This maximum loss occurs if the underlying asset's price drops below the lowest strike price at expiration. By knowing the maximum potential loss up front, investors can carefully assess their risk tolerance and decide if the short put Condor aligns with their investment goals. It's important to remember that while the short put Condor offers limited risk, it's not a risk-free strategy. Market conditions can change rapidly, and various factors can impact the strategy's outcome. Thorough research, careful planning, and a solid understanding of options trading are crucial for mitigating potential losses and maximizing the chances of success. Let's bring the short put Condor down from the abstract and illustrate its workings with a practical example using a company we all know and love. Apple Inc., AAPL. Imagine Apple is trading at $150 per share, and you believe its price will remain relatively stable over the next month. You decide to employ the short put Condor strategy, aiming to profit from time decay and your market outlook. For this example, let's assume the following options contracts with an expiration date 1 month out. Sell one AAPL put option with a strike price of $145. Premium received is $2. Buy one AAPL put option with a strike price of $140. Premium paid is 80 cents. Sell one AAPL put option with a strike price of $135. Premium received is $1.20. Buy one AAPL put option with a strike price of $130. Premium paid is 50 cents. In this scenario, the net premium received for entering the short put Condor is $1.90 per share. Since each option contract represents 100 shares, the total premium collected would be $190. Now let's analyze the potential outcomes at expiration. Scenario 1. AAPL remains above $145. All options expire worthless, and you keep the entire net premium of $190 as profit. Scenario 2. AAPL trades between $135 and $145. Only the sold $145 put option is assigned. Your maximum profit is capped at $190, minus the difference between the strike price of the assigned put option and the price of AAPL at expiration. Scenario 3. AAPL trades between $130 and $135. Both the sold put options are assigned. Your loss is limited to the difference between the strike prices of the two assigned put options, minus the net premium received, resulting in a maximum loss of $8.10 per share or $810 per contract. Scenario 4. ALAPL falls below $130. All options are assigned. The maximum loss remains capped at $810, as calculated in the previous scenario. This Apple example demonstrates how the short put Condor can generate profits if the underlying asset trades within a defined range until expiration. The key takeaway is that both profits and losses are limited, making it a potentially attractive strategy for investors seeking limited risk in exchange for capped profit potential. Now that we understand the mechanics and potential outcomes of a short put Condor, let's delve into the practicalities of putting this strategy into action. As with any investment decision, careful planning and execution are essential for maximizing your chances of success. The first step is identifying a suitable underlying asset. The short put Condor works best with assets expected to remain range-bound in the near future. Thorough research, technical analysis, and an understanding of market sentiment are crucial for selecting the right candidate. Next, choose an appropriate expiration date for your options contracts. Remember, time decay, theta, is your friend in this strategy. The closer the expiration date, the faster theta erodes the value of the options, increasing your profit potential. However, shorter expirations also come with increased risk, as even small price fluctuations can lead to losses. Once you've identified the asset and expiration date, it's time to select the strike prices for your 4 options contracts. This step requires finding a balance between maximizing profit potential and managing risk. Wider strike price differences result in higher net premiums, but also increase the likelihood of losses if the market moves against you. With your strike prices selected, you're ready to place your trades. Most online brokerage platforms offer intuitive options trading interfaces, allowing you to easily sell and buy the required put options. Always double-check your order details, including the ticker symbol, expiration date, strike prices, and number of contracts, before submitting your trades. Remember, entering a short put Condor requires a margin account and sufficient buying power to cover potential losses. It's crucial to understand your broker's margin requirements and ensure you have adequate funds in your account before initiating the trade. Just as important as entering a trade is knowing when and how to exit it. Exiting a short put Condor can be done in several ways, each with its own implications for your profit or loss. The simplest exit strategy is to wait until expiration. If the underlying asset's price remains within the desired range, all options expire worthless and you keep the entire premium collected. This is ideal but not always possible or desirable, especially if market conditions change. Alternatively, you can choose to close your position before expiration by buying back the sold put options and selling the bought put options. This allows you to lock in profits or cut losses before the expiration date, providing greater control over your investment. Another option is to roll the trade. This involves closing your existing position and simultaneously opening a new short put Condor with a later expiration date. Rolling can be beneficial if you want to extend the duration of your trade or adjust your strike prices to adapt to changing market conditions. Timing your exit is crucial for maximizing profitability and minimizing losses. Factors to consider include the remaining time until expiration, the current price of the underlying asset, implied volatility levels, and your overall market outlook. Remember, exiting a short put Condor involves trading options, so transaction costs and commissions will apply. Factor these costs into your decision-making process to accurately assess the overall profitability of your trade. In the world of options trading, there's a Greek letter that holds significant sway over your portfolio, theta. Often referred to as time decay, theta represents the rate at which an option's value erodes over time. And for the short put Condor, understanding theta's dual nature, both friend and foe, is crucial. For sellers of options, like those employing the short put Condor, theta is a welcome companion. As each day passes, the value of the sold options decreases, all else being equal. This means that if the underlying asset's price remains stable or moves favorably, the time decay works in your favor, increasing your profit potential. However, theta can also turn into a formidable opponent if the market moves against you. Remember, you're short options in this strategy, meaning you benefit from their value decreasing. But if the underlying asset's price moves unfavorably, the negative impact of price movement can outpace the positive impact of time decay, leading to losses. Therefore, managing theta in a short put Condor requires a delicate balancing act. Choosing an appropriate expiration date that allows sufficient time for theta to work its magic while also considering the potential for adverse price movements is key. Regularly monitoring your position and adjusting your strategy as needed, such as rolling the trade to a later date or closing it early to limit losses, are all part of effectively navigating the theta tango. Remember, knowledge is power, and understanding theta's role in options trading can be the difference between a profitable and a painful experience. Even the most meticulously planned short put Condor trades are not immune to the unpredictable nature of the market. Sudden price swings, unexpected news events, or shifts in market sentiment can all impact your position, potentially leading to losses. Therefore, it's crucial to have a robust risk management plan in place before even considering this strategy. This involves understanding your risk tolerance, setting realistic profit targets, and, most importantly, defining your maximum acceptable loss. One way to manage risk is through position sizing. Avoid allocating a significant portion of your portfolio to a single trade, especially one involving options. Instead, diversify your investments and spread your risk across multiple assets and strategies. Stop-loss orders can be valuable tools for limiting potential losses. These orders automatically close your position if the underlying asset's price reaches a predetermined level. However, keep in mind that stop-loss orders are not foolproof and may not always execute at the desired price, especially during periods of high volatility. Regular monitoring of your position is essential. Keep a close eye on the underlying asset's price, implied volatility levels, and any news or events that could impact the market. Adjust your strategy as needed, such as rolling the trade or closing it early to protect your capital and minimize potential losses. Remember, the short put Condor is not a get-rich-quick scheme. It's a strategy that requires careful planning, disciplined execution, and a willingness to adapt to changing market conditions. By prioritizing risk management, you can navigate the market's ups and downs with greater confidence and increase your chances of success. The short put Condor, like any investment strategy, has its own set of advantages and disadvantages. Whether it's the right tool for you depends on your individual risk tolerance, investment goals, and understanding of options trading. On the plus side, the short put Condor offers defined risk, meaning your maximum potential loss is limited. This is particularly appealing for investors who prefer a more conservative approach, seeking to generate income while managing their downside potential. Additionally, this strategy can be implemented with a relatively small capital outlay compared to some other options strategies. The net premium received from selling the options helps reduce the margin requirement, making it accessible to traders with limited capital. However, the short put Condor is not without its drawbacks. It requires a solid understanding of options trading, including concepts like implied volatility, time decay, and option Greeks. Without this knowledge, it's easy to make costly mistakes. Moreover, the profit potential is capped. While this can be seen as a safety feature, it also means that your upside is limited, even if the underlying asset experiences significant gains. If you're seeking outsized returns, the short put Condor may not be the ideal strategy. Ultimately, the decision of whether to employ the short put Condor rests solely with you. Thoroughly research and understand the strategy. Assess your risk tolerance and consider seeking advice from a qualified financial advisor before making any investment decisions. Navigating the world of options trading can feel like venturing into uncharted territory. The short put Condor, with its multiple moving parts and reliance on various market factors, is no exception. While it can be a powerful tool for generating income and managing risk, it's not a strategy to enter into lightly. Education is your most valuable asset. Take the time to thoroughly understand the mechanics of the short put Condor, the factors that influence its profitability, and the potential risks involved. Practice in a simulated trading environment before committing real capital, and never be afraid to seek guidance from experienced traders or financial professionals. Remember, successful trading is not about chasing quick profits, but about making informed decisions, managing risk effectively, and having a long-term perspective. The short put Condor, when used wisely and cautiously, can be a valuable addition to your trading arsenal, helping you navigate the markets with greater confidence and potentially achieve your financial goals. Thanks for watching, and see you next time.